Hello, welcome to my channel. My name is Alex, and in this video we'll be discussing the best way to invest in 2019. So the last couple of months we've seen how the market has been going down, and here are a couple of stocks. For example, Google is almost 9% down, Facebook 14%, Amazon 13%, Apple 21%, you can see Netflix 18%, and so on. As you can see, most of them are getting hurt right now, and a lot of people are starting to get scared. They're seeing their retirement funds going down, and they're wondering if there's something that they can do. So that's what we're going to be discussing today. So this is the Chiller PE ratio, and right now we are at 30.22, and as you can see, the mean is 16.59, the median 15. So we are way above those mean and median, and as we can see the different points where we got a crash. Like for example, on Black Tuesday it was at around 30. We are right there around 30. It was actually higher, so it's starting to go down, and the highest part was in the dot-com bubble basically. So this is something that is basically telling us that the stock market is overvalued. The price-earning ratio basically is very high. Also, we can check here in the Buffett indicator. This is also another way to kind of try to get value in terms of the market. And here it's telling us that it's also significantly overvalued, and actually is giving us a likely return for the next year. So the next likely return of negative 1.2%. So basically a little bit negative or break even, which is not great, right? So how can we take advantage of something like that, right? That's what are we going to be checking out. The next important reason to be careful is the yield curve is close to getting inverted. And why is that important? It is important because here we can see historically the yield curve has predicted the past 7 recessions. So if we get an inversion, then we may get to a recession. And of course, a recession will mean that the market will underperform. Here we can see also the different yields, and it's almost flat, as you can see. But it's not sure. It's close, but it's still not inverted. And the third reason is that there is a lot of uncertainty. That nobody really knows what's going to happen. We may go down and start a downtrend, a recession, or just continue to go up like you have done the last couple of years. So there's really no way to know what's going to happen. And the VIX is basically what is called the VIX is the fear index, and right now it's at 21.19. Last year was it got really low, below 10. So this, even though it's not really high, is still higher than the average. The average is around 15. But most importantly is this term curve of the futures, the VIX futures, and it's as you can see, is the slope is upwards. That is called backwardation. The backwardation is really small. It's almost flat. We can see it if we click here. It's almost a flat curve. So that what it's telling us is that they expect it to be around these levels for the next couple of months. So I expect a lot of two-sided actions basically, but the VIX is above it, so that means that the price of the futures most likely are gonna go up in the next couple of days. So knowing all of this, how can we take advantage of this, or what will be the best way to invest? To me is by selling premium, and what I mean is that because the VIX is high, the premium is high, and so you can sell options. what it means is that the options right now are expensive. It's like if you are an insurance company, after a hurricane, for example, all the premium gets higher, right? So that's the best time to sell premium. Another reason for selling premium and selling options is that you can put your the probabilities in your favor. So this is the trading platform Tastyworks, the broker Tastyworks, and these are the options chains look in this platform, and this is the ticker symbol SPY. You can see these are the positions that I have, and you can see that I do have a position right now. So this is a real trade that I made. The trade that I have is I sold one put over here, and I sold it for $4. As you can see, we can actually see that I got filled at $4 at 346, right? For $4, you can see the probability of this trade is 84%, right? So that's a very high probability. When it started, it wasn't that high, but of course, because it had moved, I'm already making money in this trade. Then the probabilities are very high. And here you can see this is where the price is right now, and this is the expected move, and all this green is where I make money. So that's what I mean when I say that you can choose the probabilities. Also, you can choose how much risk to take, like I just showed. In terms of the probabilities, of course, the more risk you take, the more reward. And the most important part is the capital efficiency. That's that this strategy or this style of trading gets, because options are leveraged, so you can use have the same performance or better using less capital, and that's the strategy basically. So for example, there are other profitable strategies like indexing or value investing or dividend investing, right? But all of those, you have to invest most of your capital to get decent returns, right? For indexing, let's say you're investing 90%, or you divide it in a portfolio of 60-40 with bonds and the S&P, or for value investing, you have to wait until you have a good value for your stock, right? And right now, as I just showed, the values are very high, so it's not really efficient. And if you have a lot of cash, then that money is not working for you. But with options, you can keep just only use like 30% of your capital and still get great returns. For example, in that same trade that I did with SPY, in terms of capital, only it uses like around $4,000, right? So let's say if I had a portfolio of $50,000, then I'm using less than 10% of the portfolio in that trade, and I'm gonna get $400 in 45 days basically. So that's gonna be a great return. And if I have options, then I also have more cash to take advantage of other opportunities that may arise when that time comes. So that's another thing that you have to be aware of. Also, even if you don't, if you prefer value investing, dividend investing, or indexing, it's better to understand how to trade options. Let me show you why. So this is the chart of the SPY, and let's say I want to buy. I think it's gonna go up, right? So that's actually a 50-50 chance that it goes up or it can go down. So I really don't know. But if I use options, I can actually buy low and sell high, because I am selling an option that is way below here, around the 254 strike price, and I got $4. So my break even is 250. So let's say the price continue to go down, and and it breaks my break even, the worst thing that can happen is that I get assigned and I end up buying the stock at a better price, so it's cheaper than where it is right now, and my basis will be 250. So what happens if it goes up? If it goes up, I get to keep the $4 that I got from the premium. So it's the equivalent of buying at this price and selling $4 above it, right? And let's say if it continue to go up, I can continue to sell puts every month if I want to, if I still have the same bullish idea. But what happens if it goes sideways, like here, right? We're going sideways here, then I still keep my money. I make money if it stays above this line before this time, until this time, basically. So even if it goes down and I'm wrong, if it goes down slowly and it ends, I still keep all my premium. So let's see an example. So let's say it does something like this, right? Even if it does something like this and it's going down, right? As long as it's continuing to be above my break even, I still get get to keep the premium. So if my strike was the 254, right? So let's say if it ends up above, it ends up at 255 around here, then I keep the $4, right? Basically, so it's the same as if I bought it and sold it to $4 higher. So the probabilities are in your favor. Also, I'm using less buying power for that one contract. I'm using only $4,000, around $4,000. So if I wanted to buy 100 of this at this price of 269, I will need almost $27,000. So that's a big difference in terms of the cash that I need to trade, right? So if I have only $50,000, then I'll be using half of my account that trade. But if I'm only using $4,000, then I'm being more efficient with my capital, and of course the return of my capital is gonna be higher. Also, let's say I don't care about investing and I prefer value investing or dividend investing. So let's take another example. Let's go to another broker that I have here. A good example here, I'm using AT&T as an example, since it has a 6.55% yield. So it also has options, and this is the option chain of this is the Ameritrade sink or swim, basically. And these are the different expiration dates, and let's use a similar around 43 days. I can open this one, and as we can see, we get like 50 cents of dividends quarterly, right? So every 3 months we get 50 cents per share, basically. So let's say I want to get something similar. I can get, I don't have the stock, and I can sell the 29 put. These are the calls and these are the puts. So I can sell this one, and the mid price is around 49 cents. Let's say we were able to make it to 50 cents, so equal to the dividend, and this expires in 43 days. So we will get a better return than if we had actually the dividend. And if it goes down, let's say worst case scenario, the stock goes down and we get assigned, then we will get the dividend later, but we get to keep that same 50 cents. So it's like a double dipping the dividend, right? So that's why it's always better to at least know about options, so that you can decide what strategy is best for you if you want to do value investing, indexing, dividend, or just trade options, which is what I like to do, because you have more flexibility on the things that you can do and be very efficient with your capital. Then it's important to understand what you can do. And also, let's see in terms of the probabilities again. So this is the same trade, right? So, and this is the price. As long as it stays above this break even, I'll be making those 50 cents, which equals to $50 basically. This is 49, so if 50 would be $50, because this is actually a cheaper stock. So in terms of the capital that we'll be using around $300, well, maybe a little bit more, like 400, because this is a portfolio margin account, so it might not be exactly $300, but it's also is a lot less than on the SPY. So if you don't have, let's say you don't have a $50,000 account and you have a $10,000 or $5,000 account or smaller account, then you just go to smaller stocks and you can still trade them and get really good returns and manage your risk the way that you like. And the probability of this trade will be, again, 76%. So that's great probability. It's better than 50-50. And in the worst case scenario, then you get assigned and you get the stock that you originally wanted anyway. So that's why I think that for 2019, the best way to trade is with options. The best way to invest is, if you don't know about options, learn about options and start trading. The sooner you start trading, the sooner you learn, and the sooner you can start making money. If you need any help, just ask out and I'll do my best to help you out and tell you what I think. And the thing about options is that it is very flexible, so everyone can have different strategies that adapt to your risk and your expectations. So if you have any questions, just let me know. And if you like this video, click the like button and subscribe, and see you later. Thank you.